I would now like to hand the conference over to Mr. Anup Puchari from CDR India. Thank you, and over to you, sir.
Thank you. Good morning, everyone, and thank you for joining us on Max Healthcare's Q2 and H1 FY2021 earnings conference call. We have with us Mr. Abhay Soi, Chairman and Managing Director of the company, Mr. Yogesh Sareen, Senior Director and Chief Financial Officer, Mr. Dilip Bidani, Senior Director Finance, and Mr. Gautam Wadhwa, EVP Business Development and Business Intelligence of the company. We will begin the call with opening remarks from the management, following which we'll have the forum open for an interactive question and answer session. Before we start, I would like to point out that some statements made in today's call may be forward-looking in nature, and a disclaimer to this effect has been included in the earnings presentation shared with you earlier. I would now like to invite Abhay to make his opening remarks.
A very good morning to all. It gives me great pleasure to welcome you all to the second quarter earnings call for Max Healthcare. Let me give you the key highlights for this quarter before opening it up for Q&A. Starting with the COVID update, we continue to take pole position in the fight against COVID-19 in NCR through Nanavati in Mumbai through Nanavati Hospital. We continue to have 1,200 beds dedicated to COVID. We have now treated over 16,000 patients and tested over 1.6 lakh samples to date. On the clinical side, we continue to build our capabilities. We did the world's first removal of ruptured hiatal cyst using Psych-Pro at B.L. Kapoor Hospital. We also did India's first Bluetooth-enabled pacemaker implant in a 62-year-old patient at Max Arcade. Despite COVID, we have had over 80 publications in national and international journals. We have over 80 ongoing research projects at the moment and are also training over 400 DMB students presently. Max Arcade has become a part of the prestigious Illumin 4, which is a global research project for precision angioplasty. Most importantly, we continue to serve patients from the economically weaker sections of the society. In quarter 2 alone, we have treated over 600 patients in our IPD and 25,000 in OPD free of charge. Now coming to the financials, as you would be aware, COVID is a particularly challenging time for hospitals financially, given a large number of beds, which otherwise would be utilized for higher ARPOB business is blocked for COVID, which is a relatively lower ARPOB business for us. Despite these challenges, we have been able to show a strong business performance, which is a testimony to the robustness of our business model and structural cost savings program which has been undertaken. The gross revenue for this quarter was 932 crores, which represents a growth of 53% over the trailing quarter, but is lower by 17% compared to the same quarter last year. Our contribution margin at 58.8%, while being about 450 basis points higher than the trailing quarter, was also 85 basis points higher than same quarter last year. Now, this is largely on account of the material cost savings that we've done. The operating EBITDA for this quarter was 143 crores, which represents a significant jump from the minus 22 crores in the trailing quarter. However, this is still lower by 8.5% compared to the same quarter last year. The ARPOB for quarter 2 was similar to Q1 at 46 to 47,000 levels compared to 50,000 in quarter 2 of the previous year. Lower ARPOB compared to last year is driven by lower ARPOB from beds reserved for COVID. However, the drop in COVID is more than compensated. The drop in ARPOB is more than compensated by the increase in occupancy. We have been operating at historic highs of close to 80% in the last 2 months against our normal average occupancy of 70 to 73%. While the COVID beds are operating at a 70% occupancy, the non-COVID beds are operating at an 85% occupancy. The high occupancy in non-COVID beds is testimony to the latent demand for the high quality of services being offered by Max and gives reasonable visibility on higher ARPOB business coming back in a post-COVID world. Despite lower revenue compared to the same period last year, EBITDA margin for this quarter was 16.2%, which is higher than the same quarter last year. This has been possible because of the ongoing implementation of cost-saving initiatives and synergies. As you would remember, last year we had implemented cost savings of 220 crores on an annualized basis. Only 140 of which was banked in the last year itself, as these were implemented through the year. In FY21, the remaining 80 crores of annualized cost savings are being banked. In addition to that, in current year to date, we have implemented additional cost savings of over 90 crores already on annualized basis, of which 65 crores are going to be banked in the current year and flow down directly to the EBITDA. Overall, on most parameters, we have seen steep recovery and are back on track, especially towards the second half of the last quarter. In fact, our September EBITDA was almost 4 times our July EBITDA. More importantly, towards the end of the quarter, for the month of September, while our revenues for the month was 6% lower than same month last year, our EBITDA for the same period was materially higher this September compared to last September. Our non-COVID tower specialties were between 80 to 90% of pre-COVID levels by end of September. However, we are lower by 37% on OP consultations compared to last year. Although OP to IP conversions are much higher this year compared to last year. As a consequence of improved cash flows, we have also reduced our net debt by 128 crores during this quarter. The net debt inclusive of put options now stands at 1,988 crores. Overall, I am pleased with the recovery that we have seen in this quarter, and from today's vantage point, believe quarter 3 will be a growth quarter for us. On this note, I wish you all a very happy Diwali and now open to conversation and discussion.
Thank you very much. Ladies and gentlemen, we will now begin the question answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Ruchi Srivastava from Edelweiss. Please go ahead.
Hi, sir. Good morning, and congratulations on a great quarter, especially in such a tough macro. So in your analyst presentation, you have mentioned that occupancy is back to 81% and is at 81%, and especially non-COVID is leading much better recovery, and which is showing up in your ARPOB as well. But overall, this looks like it's much faster normalization than what you were saying in first quarter, especially for non-COVID. COVID, it's understandable. So what do you make of the current situation for both your Delhi and Mumbai hospitals? That was my first question.
So in terms of non-COVID, if that's what your question is, although we are operating at an 85% occupancy, 85% of occupancy in the non-COVID beds, okay, it basically means this is nighttime occupancy. During the day, we are almost 100% full, and we have queues and waiting periods in our emergency. So there's a huge amount of latent demand as well. Unfortunately or fortunately, we've had to set aside certain amount of beds, which are, like I mentioned, at 1,200, which are being used for COVID. And, the occupancy of these beds also significantly is quite high. And we can't really utilize these beds for non-COVID. I am very certain as and when the numbers, COVID numbers go down, we have more than adequate latent demand to kind of occupy the COVID beds, which will then be converted to non-COVID. Having said that, in spite of us running both COVID and non-COVID concurrently at this point of time, and as you're aware, Delhi is in the midst of a third wave, we are at least fiscally in a very good place. We've been hitting historic highs on EBITDA, and occupancy is also at a historic high.
Sure, sir. Thank you. Second question on 3.2%.
I'm so sorry to interrupt, but your audio is not clearly audible.
Ruchi, we can't hear you.
Can you hear me now?
Yes.
Thank you.
Yeah. So just on EBITDA margins at 16.2%, how sustainable is this? You said in your opening remark that a lot of structural cost savings is to be banked this year as well. But and COVID related would be definitely transient. But how do you see EBITDA margins sustaining going ahead?
So two things. One is we were 15.2% last year in quarter two. This quarter we are 16.7% or 16.2%. So we are higher than last quarter in the current quarter. Do keep in mind in this quarter our revenues are lower by 6%. Sorry, by 16%, which translates to about 187 crores of revenues. So in order to partly compensate for this loss in revenues and increase in cost, we have some transient savings in salaries, which are, take care of about 15 to 20% of this cost or reduction in revenue. Other than that, everything else is structural cost savings. So these are not likely to disappear, and we believe there will be expansion of EBITDA margins going forward.
So Ruchi, as Abhay mentioned, I think in the course of the quarter itself, we have higher margins toward the end of the quarter, which means that which we think is sustainable. So and average is obviously lower because July honest revenues are also lower. So I think as we see, it should only improve from here.
So our EBITDA, in fact, for the month of September was 3.5 to 4 times the EBITDA of July. The aggregate margin for the quarter was 16.2%, but September clearly was significantly higher than that.
Yeah.
Okay.
And this is while we have unwound majority of the structural or the salary cost reductions that we've done.
Great, sir. All the best and happy Diwali to you guys.
Thank you.
Thank you. Before we take the next question, a reminder to the participants, if you wish to ask a question, please press star then 1 on your touchtone telephone. The next question is from the line of Sangeeta Purushottam from Cogito Advisors. Please go ahead.
Yeah, hi. Good morning and congratulations on a great set of numbers. My question was a follow-up on what the previous participant had asked. You mentioned that the September EBITDA numbers were significantly higher than July. And in your presentation, you also mentioned the occupancy rate for October. Now, going into the October-December quarter, is there any guidance you can give in terms of the occupancy rates you expect as well as the EBITDA that you're likely to get? So would that be, can we take then, therefore, the September numbers as a indication of what it will be in the October-December quarter, or is that likely to be even higher?
So I think two things. The October occupancy and November occupancy till date is higher than September.
Okay.
The occupancy is higher than September. And the second is the quarter EBITDA, like you rightly put it, was an aggregate of July to September, which was a steep hike, whilst the third quarter, which usually historically has been a weaker quarter, but in the current year will continue on this trajectory of higher occupancy. And therefore, we've also we are seeing higher revenue. In fact, there's been revenue growth in October. So we're expecting quarter 3 to be a growth quarter for us. Not we don't go back to FY20 levels, but we should be able to exceed those.
Okay. And you were anyway on a cost reduction program even before COVID. Now, as a result of COVID, are there additional structural cost reductions that you have identified?
So we've done structural cost savings. Like I said, there was, even for the current year, there was a program for about 100 crores of cost savings. These are structural cost savings other than the transient or the salary reduction, which have largely been unwound by now. But, there's structural cost savings of about 100 crores that we had identified in addition to the 220 crores we implemented last year. right?
Right.
Of this 100
My
crores,
question was that in many industries, we're seeing that there's a change, as a result of COVID, there's a change in the way of working. And that itself is leading to new ways, a new cost structure. In your case, is that also true, or is it that you continue to be on the path you had identified earlier?
No, so there have always been changes to that. So yes, there have been changes to the way of working as well. Particularly in terms of how we are conducting our OPDs and how we are doing things with digital and so on and so forth. The permanency of this and, how long these habits will last is another question altogether. So we don't really hang our hat as far as this is concerned. What we are talking about are structural cost savings, which we don't believe are likely to disappear in the years to come. And, out of the 100 crores identified for the current year, we've implemented 65 of which will get banked in the current year.
Right. Okay. And one question on your fundraising program. Is there any update that you have on that? And, in terms of quantum of funds you're looking to raise now, has there been any change, or in the end use identified, will you be using all of it to repay debt?
So, the QIP we were doing was more in compliance with our MPS norms, minimum public shareholding requirements that we have,
right.
as well as to fund growth.
Right.
As far as our current debt is concerned, like I said, even in the worst quarter, we paid down 128 crores, 130 crores of debt.
Right.
We have a net debt of 1980 crores. And given our current run rate, we believe, we are very comfortable in terms of debt to EBITDA, as well as, throwing out significant amount of free cash flow per month to pay down this debt even further. So, we don't necessarily require a QIP to pay it down. That was more to fortify ourselves for growth opportunities.
Okay. All right. Thank you.
Thank you. Before we take the next question, a reminder to all the participants, if you wish to ask a question, please press star, then 1 on your touchtone telephone. The next question is from the line of Sarang Gupta from Briarwood Chase Management. Please go ahead.
Hi, congratulations on the strong quarter. I guess one question is, given the volatility we've seen around COVID, could you give us some color on EBITDA progression throughout the quarter, and how was September versus earlier in the quarter? And I guess a follow-up on that is any color on how October performed versus September, and revenue going forward.
Hi, you were a little muffled, but if I've gotten it right, and I'm just going to try and address this. I think, like I said, September has been 3.5 to 4 times July EBITDA. And you've seen a significant, and this is largely on account of two things, which is ramp up in occupancy, which continues and in fact improves through October and November. And the other was structural cost savings that we've implemented, by September, and that again is something which will continue in the current quarter. So whilst our EBITDA was lower for the second quarter this year compared to the previous quarter by about 8.5%. In the forthcoming quarter, which is quarter 3, we are seeing it as a growth quarter for us. Because, at least from today's vantage point, we're operating at, we're hitting historically high levels of EBITDA, which we did in September. We hope to do the same given not much change, and there's only been improvements since then.
Got it. That's very helpful. And I guess, can you share us, some color with us on what you see about, the pace of recovery for medical tourism and when that comes back? And I guess any initial signs of the recovery in medical tourism that you see happening?
Right. So I think first and foremost, like you point, we are achieving the numbers that we are achieving without a significant amount of medical tourism. Having said that, of late we've seen, at least in the month of September and onward, it having returned to the extent of 20 to 25%. So we are at 20 to 25% of pre-COVID levels now, as far as global medical tourism is concerned. We are only going to believe this number will go up in the forthcoming months.
Got it. That's helpful. And one last question is, I'll get back in the queue is, how do you see as, the right run rate level of, Q2 performance for Max? Because, Q2 was obviously impacted by, elevated elective surgeries, but, also that some cost cuts, some of which are temporary and, a lot of which are structural. So, yeah, I guess, if you could help us how these headwinds and tailwinds shake out to see, what do you see as the right run rate of EBITDA for Max once, we have a normalization in all of these factors?
So I wouldn't give you exact guidance on the EBITDA, but I can tell you that we've compared to last year. If I just compare the September quarter this year to the September quarter of last year, we were lower in revenue by 187 crores, which means it's about 103 crores contribution towards my fixed costs. Only about 20-25% of that, has got kind of absorbed by the transient, or salary reductions that we've done in this quarter. So, and this is now pretty much has got wound back again, almost entirely. But, that's the amount of contribution we are missing out, firstly, from the top line. So, I mean, you can do the math, you can add that to, the current quarter run rate and figure out what it would be in normalized state of affairs. We are seeing, constant increase in non-COVID surgeries. The number of surgeries has only been increasing. We don't see this. It's still not back to pre-COVID levels because international is in fact we are still only at 80 to 90% of pre-COVID levels. We expect this number to ramp up significantly. I mean, right now the constraint is the number of beds we have on the non-COVID side of things rather than anything else. I think demand is there. It's just and a huge amount of demand because the waiting in our emergency is quite large. The queue for our surgeries and our OTs is quite long. What we are seeing is inavailability of beds, so to say. So, I mean, I'm expecting a very good quarter three.
Mm-hmm.
Mr. Gupta, does that answer your question?
Got it. Thank you.
Thank you. The next question is from the line of Tushar from Motilal Oswal. Please go ahead.
Yeah, good morning and congratulations on a great set of numbers. Just on this operating EBITDA, say if I have to compare from Q2FY20, which was non-COVID.
We can't hear you.
Am I better now?
Yes, this is better.
So first of all, congrats on great set of numbers. Compared to say Q2FY20, 156 crore EBITDA, which was without COVID. Can we have like-to-like comparison on that? So 143 would be, broadly the breakdown of EBITDA into COVID, non-COVID.
No, so I don't think that's possible because there's a lot of costs. For example, nursing costs you can't allocate to a COVID or a non-COVID bed. So we'll have to see the overall thing. But I think in the overall scheme of things, there's roughly around 23 to 24% of the revenue has come from COVID in this quarter.
And so this is a lower revenue as far as we are concerned. Because, as you're aware, our hospital operates at a significantly higher ARPOB.
Okay.
So the beds which are being occupied by COVID are actually earning us less.
Yeah, so effectively then so like-to-like comparison would have been much better had the COVID not been there.
Absolutely. I mean, like-to-like, if there was no COVID, then, you would perhaps have had a lower occupancy but a higher ARPOB certainly.
Okay.
Yeah.
And how do you see this occupancy of COVID beds panning out, let's say, on maybe 2Q and then in October, November? Is that reducing, increasing, or it's still fluctuating?
So right now, presently, it's increasing, at least in Delhi NCR region. Eventually, we are hoping, as soon as possible for this to come down like it has everywhere else. Okay. But like I said, on the non-COVID side, we are facing capacity shortages. So we are looking forward for this COVID to unwind as quickly as possible so we can put beds to non-COVID and which will allow us to earn more. So it should actually work out better for us.
Good. Yeah. And is that the reason for this ALOS remaining at a elevated level?
Yes. So that's the reason for a loss at a longer level. You have to understand, our numbers are not because of COVID. Okay, these are despite or in spite of COVID. Yeah. We are, as a healthcare chain, we are, given where we are and where our hospitals are, we are suffering due to COVID because those beds earn us less.
Got it. And on the payer profile, we have been commenting in terms of reduction on the institutional side. So how are we progressing on that?
Quite well, actually, because in a couple of hospitals we have stopped that business, and it's obviously a good time for us to do so because in any case we have such a severe shortage of non-COVID bed capacity, and being a preferred hospital for COVID, in any case our COVID beds our occupancy is higher than everybody else's. So we started on that program and quite successfully.
Okay. And just lastly, in terms of, there was also some pricing benefit which we were to have because of the Max brand per se.
So I'm sorry,
on that front,
but your audio is again not very audible. May I please request you to speak a bit louder?
So just on this TPA and corporates where the use of Max brand were to have a pricing benefit. So is that how is that progressing? Is that more or less?
That will start to flow in quarter 2. Some of the prices have already been revised and some are getting revised from 15th of November. So the way we see it, other than Jipsa, most of it will be done in this quarter. You will not see the full year or full quarter impact in this quarter. I'm saying ensuing quarter, but you will have it in quarter 4.
So quarter 3 will see a part of it, quarter 4 will see...
Yeah, but that's other than Jipsa. Jipsa is still under discussion, which is a major part of the revenue in terms of PPA.
Got it. That answers my question. Thanks.
So does that answer your question?
Yeah, that answers my question.
Thank you. The next question is from the line of Dhananjay Trika from Kotak Mahindra AMC. Please go ahead.
Hi, thanks for the opportunity. Just one small question. So yesterday we had this news where Delhi High Court had vacated stay on 80% reservation of ICU beds for COVID for 33 hospitals. So do some of our network hospitals are part of list of the 33 hospitals? And if yes, then what can be the impact?
So yes, our hospitals are a part of the list of 33. It's a slightly more complex order because it also says that a non-COVID life is as important as a COVID life, and therefore it is the obligation of hospitals to ensure that no non-COVID person suffers because of lack of bed as well. Now, we've heard the song, the third wave we're in the midst of, and essentially what it means is that you need to increase your bed capacity on the COVID side of things, and which we will ensure that it is positively impacts us rather than negatively impacts us.
Okay. So this current wave which has come, so this should not kind of delay our estimate that Q3 should be better than last year's Q3, right?
That's correct.
Okay. Yeah. Thanks a lot.
Thank you. The next question is from the line of Mayur Katani from OHM Portfolio. Please go ahead.
Hi, I just wanted to check on the branding. I mean, we continue to use the word brand Max. So is there a time frame where we can use it, or is there a royalty that we continue or end up paying them?
So neither. We own the brand Max Healthcare.
Okay, so with this merger, you own the brand itself?
That's correct.
Okay, great, sir. And on the effective savings that you've been mentioning, so I'll just run through this once. Correct me if I'm wrong. 220 was to be done was a target, out of which 140 you did in FY20. The balance 80 is to be done in process in FY21. Over and above this, you're talking about 100 crore structural savings in FY21, out of which 65 will be implemented this year and 35 will go to next year. Is those numbers correct?
No, I mean, numbers are correct, but I think you're going about it the wrong way. We implemented 220 last year. We didn't identify 220, we implemented 220. We got benefit, of not the entire 12 months of savings. Suppose if I had done the savings okay, all the 220 I implemented them on the 1st of April, then last year I would have got 220 crores of benefit to my EBITDA, right?
Yes, sir.
But because it didn't happen on the 1st of April, it happened through the year, okay, we got a benefit of only 140 crores which got banked, although we implemented 220. In the current year, EBITDA, the balance 80 would have automatically flown down because of something which has already been implemented.
Okay.
In the current, right?
Yes,
so that's already happened and you're seeing that in the numbers. In the current year, okay, we identified 100 crores of additional structural savings and synergy.
Okay.
We implemented these, okay, 90 crores of these we have already implemented.
Okay.
65 crores of which, okay, will get banked in the current year.
Okay.
Current financial year, balance will automatically fly in the next year. It's already been implemented. 10 more crores have to be implemented in the current year, of which maybe a couple of crores will, not maybe, but a couple of crores of that should come into the current year as well. So the 65 will become perhaps 67.
Got it. Thank you for the clarification, sir. And all the best and happy Diwali in advance.
Thank you. Wish you the same.
Thank you. The next question is from the line of Farooq Pandey from Avesta. Please go ahead.
Yeah, hi. Can you hear me?
Yes, hi.
Yeah. My first question was on the brownfield expansions at your existing sites. Could you just share some sort of color on the size and the cost and the timing of these expansions?
Yes. So we are looking to start the expansion in the new financial year. The site is in Delhi. We have permission to build 900 beds. At this stage, we will be building a superstructure of 650 beds, of which we will be fitting out 350 beds. In Mumbai, it will be 550 beds additional that we are building out. This is a Nanavati hospital in Mumbai, and Delhi is adjacent to a cluster of hospitals in Nashik. Now, the time frame for this, the construction period is 3 to 4 years, because these are full-scale hospitals, and these should come online 3 to 4 years later from the date when you start construction. So this is at a cost of 1,300 crores over the next 4 years. The first 2 years, when you're building, it's about 30% of the cost. Then the latter half of the thing should be 70% of the cost. But initially, you only build the superstructure, the finishing and the equipment and so on and so forth. It all comes in and paid for in the latter part of the construction period.
Okay, great. And also, so the on your cost exercise, this 100 crore figure which you had given for this year, which 65 will be banked, that is where you see this exercise ending in terms of all of the initiatives that you would have identified. And I'm also presuming that the 220 crores of last year will naturally get fully banked this year.
Absolutely. So 65 of the 100, the balance or 35 will get banked next year. So you're going to calculate it as 220 of last year title coming.
Right.
Okay, and 65 crores will have of the 100 being implemented in the present year, 65 crores EBITDA impact will happen this year.
Right.
You're right, it will get banked and the EBITDA impact will happen this year.
So that is the situation as we see today. So maybe it will go up or...
Yeah, I mean, if we are able to identify more, then it can perhaps go up.
Okay. And do we have any target debt equity or return on capital employed in mind, in the context of everything that you have said, in terms of the cost cuts, in terms of the expansions and the QIP which is coming in, further maybe inorganic opportunities which may or may not arise. So through all of this, is there any target debt equity or ROC that we can work with?
Look, so I think there are minimum thresholds. Okay, so as far as target is concerned, we try to do as better as we can. But there are minimum thresholds. Given the total amount of capital which is being allocated in the business, which is 3,600 crores. Okay. And if you see the current run rate or the exit run rate of last year, you'll see our ROCE was late teens. So I think clearly we will be, looking at the ramp up, we should be in the mid-20s, early 20s by on normalcy, given the current state of affairs. And, for the brownfield, we are looking at anything between 25 to 30% ROCE. This is on an incremental basis.
Great. And just a last
question. As far as EBITDA is concerned, we are comfortable with around 3.
Okay. And just a last question. There was a footnote in your results yesterday about some payment of Saket. Could you just explain what that is?
So I think this is basically the put option liability that we have. So this is the space that we were to buy from Modi's for the balance of that, hospital that we bought in 2015. So this liability has to be exchanged by borrowing. So that's the reason why we put that note, because when you see the borrowing on the balance sheet, that borrowing is excluding that. And so if you see the balance sheet also, which we sent to you, in the investor presentation, you'll find that after this loss, there is a put option liability that is shown. So that liability is what is it? It's in dollars as in rupee term. So since there has been some dollar movement, so there's a gain which comes up, because this liability is fixed in terms of dollars, and these liability are now resting with KKR. As KKR bought this stake from Modi's at the end of March, and we are supposed to buy it from KKR now at no profit, no loss. But the liability is both in rupee terms also is frozen. It's frozen in terms of dollar terms also. So when I take the dollar and there's a gain which comes up there, so that gain has been reflected in the borrowing costs, in this quarter. So there's one is a liability, and then there's a gain on the liability which has come up in this quarter. So these are the two notes that you'll find in the this quarter presentation.
But I want to point out all of this forms a part of the 1980 crores.
Yeah, I mean that's the reason why we put it in the balance sheet upfront.
So I'm presuming this is part of the reason for the QIP also.
No. I mean, we are not part of the reason.
So we have the debt tied up for this, liability. So IFC is supposed to disburse the debt. So this debt, I would say 85% of it is already tied up.
Okay. Great. Thanks a lot for all the responses, and wish you all the best on the way forward.
Thank you so much.
Thank you. The next question is from the line of Ashwin Agarwal from Akash Ganga Investment. Please go ahead.
Good morning, sir. Congratulations on a very encouraging set of numbers and also a very detailed explanation in your opening remarks. So you have already partly answered this question, but still, I thought the 2,000 crore debt standing on your balance sheet, and you said probably the QIP you may not go ahead with the QIP, but in such challenging times, don't you feel if you reduce your debt, you have more financial flexibility, in terms of M&A in next 2-3 years, and, balance sheet will be much stronger?
So I think there are two things. Given, firstly, 2,000 crores or 1,900 crores or whatever it is, has to be looked at in the context of the EBITDA that we have and debt to EBITDA ratios. From today's vantage point or current run rate, etc., if it is coming around 3 or below, we are comfortable with it. Having said that, you're absolutely right. There is a chance going forward for consolidation, inorganic growth, etc. That is one of the reasons we are looking at the QIP. And secondly, there's also an obligation for us, to dilute simply because we have to meet minimum shareholding norms, and we have to do it before August next year. So from that standpoint, we will be doing it if it kind of matches both the purposes. So we're not saying we are not doing a QIP. What I said is we don't need to do a QIP to deleverage.
Okay. I wrongly misunderstood. I thought you had put the plans on hold.
No. That's not what the idea is.
Okay. Thank you, and wish you best wishes for Diwali and exemplary performance. All the best.
Thank you so much.
Thank you.
Thank you. The next question is from the line of Ashish Thakkar from Motilal Oswal AMC. Please go ahead.
Thanks for the opportunity. Sir, a bit of your commentary on the oncology side of the business. How do you see that business, shaping up overall broadly at the industry level, and also specifically for your entity?
So we are one of the largest players in oncology in India. We have a significant, the largest part of our business comes from oncology, which 16% has been oncology, which traditionally also has been growing at 16% per annum. In fact, during COVID, at present, this business has grown
it's down to 18.3% actually.
to 18.3% of the total. And so we've seen comeback and ramp up and growth in this business. It is one of our mainstays. We intend to continue focusing on it. Of course, as the disease burden is only increasing in India, so we see an opportunity from that standpoint, to be able to focus further on this.
So, but are you seeing a month-on-month improvement over the in patients' footfall here?
Absolutely. We've been seeing it even prior to COVID. Like I said, that business has been growing at 16%, much higher than any other business. It is formed 16% of our total, disease mix, which is far higher than any other business vertical that we have. And even in COVID, we've seen it increase. And going forward, we don't see this abating. We believe that there's a huge shortage of clinicians as well as infrastructure to serve cancer.
Okay. And how about the OPD, sir? Are like dermas, like ophthalmologists, all these specialists are coming to the OPDs now? Or you still feel there's a case for digital thing to go ahead?
I think three things. International, although our business, most specialties are back to 80-90% across the board. The three things which have not happened so far and which will happen going forward. One is international business, which hasn't come back entirely. The second is the elective surgery, what we call really elective, such as the ophthalmology, dental, and all of that stuff that you're speaking about. That is yet to come back, even including because it's not necessary. Third is OPDs as a whole. Whilst conversion rates have improved, have gone up, okay, the total number of OPDs are still significantly below pre-COVID level.
70% is normal.
Yeah, so it's 70% of normal only as yet. So that again, as this whole COVID abates, is something which will come back. It's pretty much like people going to the walk-in in malls is low, or the conversion is high. Because whoever going to a hospital or going to a mall has their purchase or has their conversion in mind, is not looking at shopping around.
Okay, but you feel that it will take some more time than expected, so 3-4 months, or how do you see the things panning out?
These three things I clearly believe, international perhaps may come back sooner because it is based on necessity and it is something which is stopped not because of anything else, but the flights being reduced to India. And once those flights come back, that is something which will. The second two are more to do with COVID. Like I said, international got more to do with the lockdown that we have across for international flying into the country, etc. But the other two, which is OPDs and this thing, has got more to do with COVID and the fear psychosis. As COVID abates, this will abate.
Okay, fair enough. That's all from my side. Thank you.
The oncology has grown in Q2 over Q1 by 28%.
Okay, and you said the contribution is now 18% of the total sales, right?
That's right, yes.
Okay, fair enough. Thanks, sir, and all the best.
I see growth on this in Q3 over quarter last year as well now.
Great, sir. Thank you so much.
Thank you. The next question is from the line of Kunal Randeria from Edelweiss. Please go ahead.
Hi, good morning. So if you could just explain us the revenue growth levers for the next 3 years until the Capex that you are doing and the beds are ready. So because you are pretty much maxed out, it seems, on the occupancy side of things, and ARPOB growth might be limited going forward. So if you could just explain, how you see the revenue growth in the coming years.
So I think firstly, on the ARPOB side, there's a huge amount of growth because even pre-COVID levels, we were at 51,000 ARPOB. We are at present at 46 and a half. So there's been a huge reduction of ARPOB. So when you see normalization, that is something which will go up. Second, and most importantly, a very large amount of the business, 36% of our beds are catering to institutional business. And this institutional business is at a 40% discount to our normal hospital rack rates. We will be, rather than keeping beds empty, what we do is we earn less from beds, similar to airlines. And we are unwinding this. We already have a huge amount of latent demand. So what we are going to be doing is, what you're going to see is churn or a payer mix churn happening over the next 3 to 4 years, where we will bring this, 36% business down to about 15% over the next 3 years. The rest can be used for the higher paying business. Do keep in mind the operating expenditure for these beds is already being incurred. So essentially what happens is, the minute you're able to instead of an institutional patient, put a cash paying patient or an insurance patient or an international patient on it, you are able to earn 40% more from the same bed.
Right. And so you're very confident that this can be achieved in the next 3 years or so?
Oh, absolutely. So if you see some of the other healthcare chains, which are a lot more mature than us, their dependence on institutional business is significantly lower, compared to us. A normal trajectory of a hospital or a younger hospital chain would be, you kind of fill up your beds with all sorts of payer mix, the high paying one and the low paying one, because you want to do more occupancy. And then over a period of time, you kind of start moving away from it, and you have this payer mix churn. It's also a natural trajectory for a hospital.
That's very helpful, sir. Thank you and all the best.
Thank you.
Thank you. The next question is from the line of Prateek Mandana from Nomura. Please go ahead.
Thank you, sir, for the opportunity. I just have one question. I read in the PPT on the strengthening of digital platform, and that a significant ramp up has been happening in the teleconsulting, and over 11% of consultations are digital in 1H. So exactly, what kind of revenue contribution are we making from this digital platforms, and what is the future for this? How we see this landscape in future?
So I think, it forms a part of the OPD. What we are doing right now is OPD consults. What we've been doing some time back is also delivery of medicines at home, diagnostics, and so on and so forth. So going forward, we believe this forms a part of our Max at Home service. We've been fairly successful in that. At this point of time, it is extension of our services, providing the convenience to our doctors as well as, our network of hospitals. Going forward, and frankly, this is not something new to us, because we invested in a proprietary platform about 4 years ago. It's only now the idea and the time has kind of converged, and what we've seen is the doctors as well as the patients being able to embrace it a lot more. Whether to make it agnostic to us and put it into a separate company, or keep continuing as an extension of our own hospital services, is something that has to be seen. But clearly, digital is here to stay. What was in the peripheries of most sectors and most businesses, we've all embraced, and more so healthcare to health tech. And this is helping us reach more and more patients, and this allows us better conversion to IP. The more people we reach, the better conversion to IP we can do. The better pre-consult and post-consult is likely to help a lot with the international business, particularly with the post-consult and so on. From a hospital standpoint, clearly this environment has been a blessing in disguise, because the dependency on health care platforms, or these digital platforms, increased both from a doctor and a patient standpoint. In terms of revenue, it's still marginal, it's likely to be marginal in the coming, in the near future at least. This is all about scale, and I don't think anybody is playing for that scale. Right now, it is for us an extension line, keeping our patients at the core, and to be able to reach them seamlessly, and efficiently.
Okay, got it. And so one more thing. So the doctors that are consulting are just on your role, or there are also external doctors who are not associated with Max, and they are also on your digital platform?
So, we work with close to 5,000 GPs. We also work with other nursing homes who work with nursing homes and so on. We, at this point of time, we've just kept it for our own doctors, and at some stage, we will be extending it to others. But that is to be seen whether it is going to be agnostic platform, not agnostic platform, what some of the other players such as the big boys who are coming into the country, including Jio and so on and so forth, are going to be doing. Because that's a different space altogether. Right now, we are building it as an extension of our own services, our own doctors.
Okay. And so what was this 11% number like pre-COVID? What we have 11% of total consultation in H1. So what was this number pre-COVID?
So it went up to 16-17% during COVID. It was less than 1%. I think it would be less than 0.1% pre-COVID.
Okay, got it. Thank you, sir. Thank you. That will be all from my side.
Thank you.
Thank you. The next question is from the line of Praveen Sahai from Edelweiss. Please go ahead.
Thank you for taking my question, sir, and many congratulations for a good set of numbers. The first question is related to your internal medicine contribution. Is that a COVID contribution included in that? In presentation, 20% of your revenue comes from that.
So I'm not clear what the question is.
So in the presentation,
hospital revenue, 30% of the revenue comes from pharmacy, from the medicines.
Medicine. So that's an increase significantly from a 10% contribution to 20%.
No.
Yeah. So this is about the internal medicine contribution. Yes, you're right. That's part of the internal medicine and pulmonology, which is why the contribution has gone up in H1 and Q2.
Yeah, these are the two specialties that we're talking, not medicine per se, but this is the internal medicine department. Obviously, the contribution went up because of the fact that all these COVID patients are admitted under either internal medicine or pulmonology.
Okay, sir. And secondly, in the previous participants' answer, you said that there is a more scope for improvement in the ARPOB. So it's a more to do with the your cardiac ortho is not reached to the pre-COVID level. That contribution is lower as compared to that time. So that is expected to improve, and that's going to improve your ARPOB. Or is there some price improvement also you are expecting?
So I think there are two things. One is, without COVID, pre-COVID, we were operating at 51,000 ARPOB. Because 30% or 1,200 beds are doing COVID duty, which generates lower ARPOB, it is pulling our entire ARPOB down. So one thing, like you rightly said, will happen, once we get back to normalcy or pre-COVID levels, where the percentage of COVID business goes down and the non-COVID goes up, we'll automatically get back to pre-COVID levels of ARPOB. After that, we also have every year a 2-3% price impact. And then, like Yogi said, we have also been negotiating our insurance and TPAs. Okay, so there's going to be price impact improvement through that as well.
Also, when we filter or distill this institution channel revenue, that will also help us improve the ARPOB.
Yes. So when we move away from the institution business, we said that earns us 40% less. That is something which will improve ARPOB as well.
Great, sir. And secondly, on your TPA contribution over last half of a year has increased to a 30% plus. So will that continue at this percentage, or with the COVID subside, this will also go down to a 25% or 26% TPA contribution?
So our take is that after the COVID, the insurance penetration levels have gone up, because we were talking to some of the insurance companies and they said that they sold as much as in April itself, as much they used to do in a quarter. So you can understand that the penetration is going up. So we expect this revenue to maintain at this level. But I think we'll have to really see how this whole thing pans out. But as of now, this is what we heard from the insurance companies.
So, I mean, the minute you put international into it, you'll see the TPA percentage come down as a total. On the whole, we see it go up. But I think the wrong way to see it as a percentage, because you also have international, which is not a part of it. The minute you make that 10% or 12% or 13% of the revenues, the relative percentage of TPA will go down. But in absolute terms, I think percentage will go down, but absolute terms it will go up.
Okay. How much is the percentage of a revenue comes from the NCR this quarter?
This quarter,
so 84% of revenue generally comes from NCR.
So as for this quarter or this half?
Yeah. I'm not calculated this quarter, but I think that's the number that generally is kind of safe.
Okay.
And higher stickiness for this quarter. It was less from outstation and so on because I guess COVID has also created some barriers for traveling.
Okay. Sir, last question is there any revenue related to the COVID or associated to the COVID has been booked in non-COVID revenue, like some extension of COVID that is booked over here in non-COVID? Any related revenue?
No, I don't see. Again, what's the question?
So, if the patient come from the COVID and some related to the COVID, there is some, the revenue or some, test you done which is non-COVID basically, but that is due to of a COVID the patient is going for. So, any element of that?
No. So anybody in the COVID ward, okay, any test or any related this thing, even with respect to comorbidities, while he is in the COVID ward, okay, will be booked under COVID.
Okay. So whatever
non-COVID ward. Now, for example, if a patient comes COVID, okay, has comorbidities, he will be booked under COVID revenues. If he becomes COVID negative, okay, and has a heart problem and moves into the non-COVID section, and he's like a regular patient who is non-COVID, at that time he will be booked in non-COVID. But just because you've done a test which is, anything done on a COVID patient is booked as a COVID revenue.
Okay, once he is COVID negative, then after that's the normal revenue you are booking.
He moves into a different section of the hospital, right?
Yeah.
He becomes a non-COVID. He is going to be.
So I think typically in our system we have identified COVID beds. All right. So anybody admitted to one of those beds will be a COVID patient, and for that purpose, all revenue will come to COVID side.
You don't mix COVID and non-COVID patients, right?
Yeah, exactly. So, okay, thank you, sir.
Thank you. The next question is from the line of Kitika Gupta from First Voyager Advisors. Please go ahead.
Hi, Abhay. Great set of numbers. I have one follow-up on an earlier question on the revenue drivers relating to the increase in the decrease in the share of the institutional patients. Now, this is one driver which has been spoken about for a long time, and the earlier management was trying to bring down the share of institutional business, but we've seen it remain at 25-30% of revenue. So, wanted to check what are the challenges here, and how confident are you of bringing this share of business down?
No, we're very confident about it, and I don't think we have much of an option. We already capacitated out. It's a normal quality of events. You move away from the lower ARPOB business. It may have been thought about in the past, but we've already started implementing it. We've done it entirely in our Gurgaon hospital. 20% of business used to be institutional business. We brought it down to zero. That hospital pre-COVID was doing a 61,000 ARPOB, in fact, and a 25% EBITDA margin. We started this journey in our Saket hospital as well. We moved away from ECHS now. We have done it in our Patparganj hospital. So we are moving away from this business as we speak.
Okay. And is there a transitory impact when that happens, in the sense that as the occupancy come down, because a large proportion of your patients at least sometimes moves away?
Not really, because this institutional business is not one homogeneous one contract. These are multiple contracts which kind of represent different pools of institutions or different silos of institutions. Some are large, some are small, but just to put in overall perspective, I basically need to increase the occupancy. If I take out 10 beds from institutional, I need to fill them up with 4 or 5 beds to break even on the EBITDA.
Okay.
Right. So we haven't seen that as a challenge, and of course, we're not doing it for the sake of it. We won't remove the business for the sake of it. We remove the business only and to those specific hospitals, and that's the entire program. That we're doing it where we believe that there won't be any loss in revenue. So we don't foresee any loss in EBITDA because of this.
Okay. And would it be right to assume that the margin or the EBITDA per bed on the institution is almost half of the regular bed?
Sorry?
So EBITDA per bed for the institutional business, how much lower is it as compared to a normal bed?
Oh, so typically what we're saying is that there are 100 beds of hospital and we fill up only 45 of them, we will be home in terms of EBITDA. But really, EBITDA as we speak is negative EBITDA. Yes. Okay, I mean, you can imagine, if you're looking at a 20-odd% sort of EBITDA margin, and this is a business at a 40% discount, then overall the EBITDA is negative. It's contribution positive, EBITDA negative.
Okay. Great. That's it from my side. Thanks.
Thank you. The next question is from the line of Aditya Khemka from InCred AMC. Please go ahead.
Yeah. Hi, Abhay and team, and thanks for the opportunity. Happy Diwali to all of you.
Hi.
So just a couple of questions on the medicine part of the business. You said that, in the presentation it says 20% of your sales this quarter came from medicine sales. You think this is a new normal given the way your business mix is evolving, your case mix is evolving, or you think this is an aberration driven by the lower lead generation from the OPD in the current environment?
Clarify, it's not 20% from sale of medicines or pharmaceuticals. It is 20% from internal medicine. Internal medicine is a stream, like pulmonology, like oncology, like cardiac. So when a COVID patient comes, he meets an internal medicine doctor. What he practices is internal medicine. The sales is not coming through sale of medicine.
Understood. Sorry about that misconception. So what part of your revenue comes from sales of pharmaceutical products?
So typically in any hospital, 28 to 30% of the revenue will come from sale of pharmaceuticals, right? And we'll be no different.
Understood.
And that hasn't increased.
Yeah.
Okay. And this 28-30% of sales from pharmaceuticals, could you further give us some color on how much of this would be from oncology drugs?
Oncology.
So I'll tell you that of this, of this 30%, typically 13 to 15% of that would be in the OPD, which will be max chemist. This is the OPD pharmacy store that we have, in hospitals. And balance will be in IPD. In IPD, 1/3 of drugs are typically oncology.
Sorry, how much is oncology within IPD?
Capping on onco drugs as you're aware.
No, sorry, I missed that number, sir. What part of IPD would be oncology, sir?
So let's say, first of all, if I have 30% of the revenue is oncology, is the medicine, assume for a minute, then 15% of that, 13 to 15% of that would be sold in the OPD. So balance 85%, 1/3 would be oncology, 2/3 would be non-oncology.
Got it. 1/3 of the IPD medicine sales.
Yeah, that's ballpark numbers I'm giving, huh? Because this includes daycare as well.
Yes. Understood. Just one last question. So, what is our total budgeted Capex over the next 3 years? Because I understand we are going to do some brownfield Capex in some of our facilities, including Nanavati, Saket, etc. So just wanted to understand the total Capex budget over the next 3 years.
So it's annually over the next 4 years. It's 1,300 crores over 4 years.
1,300 crores over 4 years. And other than the dilution that we have already planned, Abhay, to bring down the promoter stake below 75, other than that dilution, would you need to raise more funds to fund this Capex, or rest of it can come from internal accruals?
No, absolutely. So we don't, it can come from internal accruals. We don't, just to put it in perspective, we have prepaid debt. Like I mentioned, we have paid 120 crores of debt in the last 150 crores of debt almost in the last quarter. We don't have any amount coming up over the next 2 years.
Right.
Even if I take including put options, if I take the debt at 1,980 crores, you're looking at about interest cost of about 15 crores a month. In addition to 15 crores a month, we have a maintenance capex of 10 crores a month. That's 25 crores, right? All in.
Yeah.
I may have an increase in working capital of another 4-5 crores. So say, look, 30 crores of total commitment that I would have on a monthly basis on a growing business. As against this, if you see my present EBITDA or where we are, the current run rate, etc., significantly higher than that. And that is the differential or additional cash flow that we used to pay down the debt over the last 3 months.
Right.
Even if you look at my total Capex requirement of 1,300 crores, 30% of it is going to be spent over the next 2 years. 70% of it is going to be back-ended.
Understood.
Right? Because first 2 years you only make the superstructure, and the back-ended on the latter half of the construction period is where the expensive equipment and the fit-outs and all of that kind of stuff happens.
Right. And all of this is on the asset side, right? Where they will lease the building and the land, or do we plan to own the building and the land?
No, so yeah, I mean, we are going to be, well, it's not going to be asset light because the land is leased, okay, and the building we are financing. So whether it's owned or leased is not the point. We are financing the building in both the cases. The advantage over here is these are brownfields, okay, unlike greenfields. These are adjacent to hospitals which are already operating at very high capacity. 4 years later, we'll be bursting out our steam. And typically in a brownfield, you don't have the 20-25% of operating losses that start up, which you typically have in a normal hospital.
Yeah, I understand that. Just sorry, one follow-up on this again. So the equity dilution that we need to do, I mean, have we decided whether we will issue fresh equity to shareholders so that the promoter stake comes down, or will the promoters have come and sell his equity? And
promoters are not looking to sell any equity. Okay, we will be only doing dilution, maximum up to about 1,000 crore, and that would just get us past, I think, MPS requirements, etc. This will also help us fortify our balance sheet further, okay, to take care of any inorganic opportunities. As you're aware, over the last 10 years, at least my growth has come through consolidation and unlocking value and creating value in assets that we acquired rather than greenfield. We intend to stay with that course because we've been on ROCE as well as from allocation of capital standpoint makes a lot more sense to us. We want to stay the course on that, and I believe this post-COVID we will see a lot of opportunities come by.
Perfect. Thanks a lot, gentlemen, and all the best.
Thank you. Thank you.
Thank you. The next question is from the line of Kapil Banga from ICRA. Please go ahead.
Yeah, hi. Thanks for taking my question. Would it be possible for you to share the OPD traction as compared to last year? What is the percentage footfall that we are seeing now?
We are only at 70% of last year. Okay, so the IP obviously is more necessary. We do quarterly care, so that sort of bounce back has happened much sharper. But OPD is not entirely back because people are still hesitant to come to hospitals, like they have to go to malls or shopping and so on and so forth. And these are typically vulnerable people who are unwell and therefore a little more concerned or sensitive about going out. So clearly OPD is only 70%. But as things normalize, this should come back to us as well.
Okay. Could you also share?
Like I mentioned, is much higher. Okay, because when they actually brave going out, such people, they're going out with a purpose only when they have to. So the conversion from OP to IP conversion is increased.
Yeah, and also within the OP, we'll find that even the pharmacy sale is still lower. I mean, let's say the consults are 65% normal, the pharmacy sale is roughly 60% of the normal. That means the people are coming, but they're not even buying medicine at the pharmacies in the hospital. Similarly, even the diagnostic are a bit lower. The optal is still further lower. Optal is roughly 55% of the normal. So I mean, it varies within the OP, but I think consult, as Bhavya mentioned, is 65-75% of the normal in the quarter.
Okay. Could you share the trajectory of occupancy over the last few months? How has it progressed post the sharp dip in April? On a month-on-month basis?
In the presentation, for this current quarter, in June it was 61%, in August it was 66%, in September it was 77%, in September, in October it's 79%, in November we are seeing again 80%.
Sorry, November, how much did you mention?
Right now we are seeing 80%, but I guess Diwali will have coming back. It'll be more than 79-80%.
Okay. Just last question from my end. Earlier in the call, you mentioned that the medical tourism business is about 25% of what it was last year or pre-COVID. So this 25% is primarily coming from neighboring countries, or we are getting some patients even from the Middle East and other African countries?
We are getting from Middle East, we are getting from Africa, we are getting from, so it's actually, it's an even spread.
Okay.
Eastern Europe.
Okay.
Yeah, and this 25% is as of now. I mean, we see it in October, November, right? You know,
Yeah.
it's not.
So this was not there in the last quarter. We are seeing it in October, November. Only over the last couple of months has this business really come in.
Okay.
In Q2, you did not have this business.
Okay. Sure. Thank you so much for taking my questions, and congratulations for the excellent performance.
Thank you.
Thank you. The next question is from the line of Lakshmi Gupta, individual investor. Please go ahead.
Hello.
Lakshmi Gupta, your line is unmuted. Please go ahead. As there's no response from the current participant, we take the next question from the line of Sangeeta Purushottam from Cogito Advisors. Please go ahead.
Yeah, hi. What I wanted to check was that are you also going to be participating in any COVID vaccination program that the government would take on going ahead, like some of your competitors have said they would?
No, absolutely. So whatever programs we have called to or we can enlist in, we will certainly be going ahead in that. We have the capacity of inoculating most of the NCR and very quickly. We have the cold chain network and so on and so forth. Right now, the government is not clear, at least even if they're clear, they haven't really communicated to the private sector how they would like to get engaged. They wanted to do it as a part of the election process. So whether they'll be using their own infrastructure, but our entire infrastructure is available. Not only our infrastructure, but the 6,000 GPs that we interact with, as well as our own GPs, doctors, 8,000 odd nurses, everybody is on call for that.
Is that likely to be a profitable activity?
Look, I think we'll do it whether it's profitable or not, but one doesn't know right now what they are paying. In the UK, for example, a normal inoculation cost, GPs are paid £11, and I'm told for COVID they will be paid £18 per inoculation.
Right.
That may not be a yardstick for India at all.
Right.
Whatever it is, we will do it even if we have to do it without compensation, right? I mean, look, something like this, you're not going to hold back.
Right. Okay. All right. Thank you.
Thank you. Ladies and gentlemen, that is the last question for today. I would now like to hand the conference back to the management for closing comments.
So thank you all and wish you a very happy Diwali. Let me not hold you back. It is earnings call season and, thank you for being on Max Healthcare earnings call for the second quarter. Look forward to having you and addressing your questions for the third quarter sometime in January. Thank you. Bye-bye. Thank you very much.
Thank you. Ladies and gentlemen, on behalf of Max Healthcare Institute Limited, that concludes this conference. Thank you for joining. You may now disconnect your lines.